To remain updated with the latest business news, click on the bell icon.
Hello and welcome to the Business Today show. This is the pre-budget market special with just 2 weeks to run before the union budget this time round. I'm Udayan Mukherjee, with me is Abha Bakaya, and our guest on the show today is Samir Arora of Helios Capital. Samir, good to see you on the show again. This time, should there be any expectations from the budget, or corporate India has never had it so good with taxes? On top of that, is it just enough to say no news is good news? Just don't do anything to rock the boat. We don't need anything from the budget from a corporate or a stock market point of view this time?
I would think that is a very fair assumption, that we don't need anything. But if you see the papers, these guys are still trying for some benefit here, some benefit there on unlisted equities. And sometimes I read that even on COVID expenses or work from home. But generally, I would totally agree that there is no need for any new things to happen. And if anything bad doesn't happen, that will be a good budget.
But what's the general sense about this year, Samir? You're sitting in America right now, where over the last few days we've seen intense volatility in the technology, high growth technology stocks in the Nasdaq. But here things seem to be quite calm in India. If you had to look forward, are you expecting a lot of volatility this year, or do you think the market's more or less at peace with what is expected and it should not be a very rocky year?
So I think right now it's at peace. The only thing is that the interest rate hike assumptions or forecasts have been going up very rapidly from maybe one a few months ago to now. Recently, I read Goldman Sachs says 4 in this year alone. But even there, if you look at the total cumulative hikes that are forecasted, which are 8 to 9 over 2.5 years, which is 4 in 2022, then 3, and then maybe 2 or 3, that cumulatively adds up to say 2 to 2.5%. And that would only take us back in US to merely back to what it was in 2019 mid, so pre-COVID. So if all other parameters are going up to pre-COVID levels from GDP, unemployment, blah, 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 whatever, then to say that interest rate should not go back to 2.5% by 24, I think it would be too unreasonable. So I would think that in that sense, because currently you are in transition from one era to another. But if you also look at this thing that, long tenured equity where there is a lot of valuation, those are correcting. Actually, if you look at the big 4 or 5 tech companies, they don't have very high valuations. Google or Meta, maybe Amazon has a little bit more, but none of the others would be in the 20s. They would be lower than most consumer companies anywhere in the world also. So I think a little bit of I'm hoping or expecting that it is shorter term, and that these interest rate hikes would be sort of par for the course in terms of from where we've come, and why should it not go back even to pre-19 levels? For India, the only thing is that will they follow a little bit?
Yeah, sorry.
No, for India, the only thing was whether India will also have to maybe preempt or have 1 or 2 interest rate hikes, just because Indian inflation is also high. But actually, Indian inflation these days is lower than US inflation. Indian inflation consumer is below 6 and US is 7. So let's see, that's also a new thing for us in our life to see that.
But how has your positioning changed, Samir, in terms of whether you remain as bullish as you were a few months ago, or has that long short position in a fund like yours changed to factor in higher volatility this year?
No, so the first thing is that you may have lower expectations from the market, but that still may not need a change of positioning, because all you want is that the market should have reasonable returns going forward, let's say in the mid-teen range. If you get more, we take it, but we don't get overly excited unless it is very visible that there's an angle to it. So today we are expecting that the market will be positive for this year, and it will be reasonably positive. And therefore our net is in the high 60s range. Our average for the last 16 years is about 62%. Right now, it might be 68, 69% because the momentum is there. And that last 5-7% can be cut in any sort of lowering of expectations, or even more if there is a bad thing happening. But right now, as long as you expect that the market will have mid-teen kind of returns, which is what I think is possible, and I can explain, then there's nothing much to change in that sense. The only thing is sometimes with which stocks to short and pre-budget, You will short some different kind of stocks. But generally this year we have been shorting only the very high valuation stocks.
Where do you see the spending coming in this year, Samir? There's always calls all around for government spending on capex and mixed views on that. On one hand, there are reports which suggest areas like railroad power will benefit, and there are other reports that suggest perhaps capex has still been lagging behind. And will the government really have enough room to maneuver and spend as promised?
Actually, what I read very recently, I think it was a Credit Suisse report, if I remember, that the government has not been able to spend as much as the money that they have. So which I had not, I mean, I don't focus on these things day to day, but they said that 2% of, the Reserve Bank of India has some $60 billion or 2% of India's GDP in cash, which is lying on account of the government money, which is there, for which the projects may not be ready, or maybe the spending is not on yet. And the idea was that there is enough room to spend even the money that you already have in your pocket. So I think the issue here might be that the projects are not ready to absorb this much money. Instead of just saying that the government does not have money, simply because the government's fiscal deficit target is quite high if you don't look at it compared to the COVID time, but the pre-COVID time, to have 6.8% kind of thing when we used to have 3.5% before. There is enough room if we accept, or the markets accept, that you are going to only go down gradually and not go back to pre-COVID soon. The thing is whether there are projects which can absorb this kind of money. Right now, it seems that is the problem.
You said something interesting, Samir, just now, that you look at stocks which you can short before the budget. So were you alluding to names like, say, tobacco, which usually get a kind of a whipping before the budget? Or is it like the Asian paints variety, which are expensive, which you also spoke about?
Yeah. So the thing is that previously we used to short tobacco. Now we have stopped because the stock hasn't moved up for many years. So even if they disappoint, I don't think it's falling few percent here or there. What I meant was sometimes in these sectors where manufacturing or infra, which in the olden days, we would, go long saying that, if you remember, we used to have this great railway budget and they would talk about security, spending on railways and switching systems, and everybody would start looking around. Now, actually, just to tell you the truth, this time I will not even be seeing the budget because I'll be in a flight from New York to Singapore on that day. And later on, I realized that was the budget day. And we concluded as a company and 2-3 other friends that it was not worth spending $500 for 2 tickets to change to be able to see the budget.
Oh, that tells us what you think of it.
That tells you.
But let me ask you about one sector which you have always been a fan of, Samir, which is the sector of the last few months, actually, IT. They used to trade at 18-20p multiples, and all of a sudden over the last 2 quarters, last one, and they've come up to some 35p multiples. So how, 30 then, how are you approaching this newfound confidence or growth optimism in IT?
No, so the thing is, that's what I said, the point is whether on a relative to India, relative to the world, in terms of comparing it to other similar stable compounders, longer term, say consumer staples. The thing is your return expectations might change, but it still might be in the top 1/3 of Indian stocks. It's like HDFC Bank kind of story. You may say it is not the best bank, but if you have to choose 25 stocks in India, you will still choose HDFC Bank because you know that in the end it will do well. I mean, for us, it's one of our top holdings. What I mean by that is that IT, your expectations of return might be lower, but they are currently in a sweet spot where you see that revenue growth for Infosys in the order of 20% per year-on-year kind of numbers. For that scale and that size, it's a relative to India choice, but it is very good right now, I think.
Okay. What about, and it may not be a sector you focus on much, but I just want to get your expert perspective, Samir, because consumption at this point is a sore point. There's a lot of talk about how income at the lower level isn't bouncing back, staples are going to lag behind, so on and so forth. As a theme, do you continue to see this playing out, while on the other hand, of course, we've got discretionary still possibly looking up, fantastic set of sales numbers coming in today, for example, but staples definitely lagging?
So I agree with you for nearly the whole thing. So first is that we don't believe in billion consumer stories,
Okay.
where because once you say billion or 1.3 billion as the denominator, then everything looks that there is massive opportunity. Secondly, I totally agree, and I've been saying it for 2 years, that there is massive disparity in Indian income and growth these days. Because you see restaurants are closed, malls are closed. How can that crowd be compensated for the loss in earning? Because I see that in Singapore, where I think they've spent more than $100 billion and a lot of it on basically making direct compensation to club owners and restaurant owners and theater owners and stuff like that. And obviously that has not happened. And thirdly, because of this disparity, the discretionary consumption has gone up. But there, what we did over the last 6, 8 months was that there is still an impact of high inflation on consumer durable and stuff like that. So we have gone into basically saying you will eat more food kind of thing. So we own McDonald India and that Pepsi. I mean, none of them are actual, but they are the franchisees, which is McDonald
Right.
India, which is Westlife, or the Pepsi India, which is Varun, or the Domino's India, which is Jubilant. So that kind of thing, saying at least you'll spend on that. Even if you say that, oh, why should I pay 20% more for some consumer durable because of sudden increase in commodity prices? Plus, also from a company point of view, it may be more difficult to pass on such high, increases in raw material cost.
Sure.
But overall, we agree with you. So we said discretionary service kind consumption
Okay.
in middle class India. That is what we would like if we can.
Okay. I want to talk about IT for just a minute longer, Samir, because I want to ask you whether you are still sticking with high quality, stable IT companies like the TCS and Infosys of the world, or does it make sense to go down the ladder and talk or own the Mindtrees and Tech Mahindras, those kind of names, where growth is probably a bit higher than the Infosys and TCSs?
So we have five of them actually. We have TCS and Infosys and L&T Infotech and Tech Mahindra and maybe one more. So the thing is, these days, in the tech sector broadly, we have not gone into much smaller IT because the big IT does the job, and it is a stable part of the business. And maybe sometimes the smaller IT companies are trading cheaper, but not anymore. So either we should, of course, we did well with L&T Tech and L&T Info Services for the last 1.5, 2 years. But today they don't look materially cheaper on these mid-cap companies compared to the larger companies. There's no point in being 5, 7 PE points lower. Either you should be 30, 40% lower than it is sometimes interesting. So I would think it is a mix, because we broadly believe that we've got the theme right and we've got the stocks in general right, but which one gets one order and which one suddenly, is able to do something innovative or new, that we will see as it goes. But we have the good companies from the IT sector, and we are playing it as a sort of a group.
Okay. Let me ask you about the other stock you mentioned, HDFC Bank. I mean, it's in every blue chip portfolio, but it's disappointed over the last 1 year. And in the first time in many years, I've heard people question whether it should belong to the portfolio or it has really outgrown or outlived its importance and it should be chucked out now. How would you address these concerns?
No, I have no reason for that. The thing is that over the last 1 year, there has been nearly 2 billion of selling by foreigners in HDFC Bank. How you can easily see that is by looking at foreign ownership, which was at 70, whatever, 4 is the limit. So it must have been 73 point something, and now it is some X% lower, which amounts to around $2 billion. So 2, 3, 4, or X number of people are selling that. First reason for that is that it is not in the index for foreign investors. It is not in MSCI India because it was at foreign ownership limit, and MSCI India removed it from being number one stock to out of the index. And therefore people kept it for time when they thought it is outperforming, and now they feel it is not. But the point is, now is the turnaround time. If you see the latest results, now is the turnaround time. Now is the time when the fintech companies are basically not putting up their hands, but effectively saying that it is not as straightforward to be direct lenders than to just collect data. You can see the NPAs of the fintech companies to see how poorly they are lending, and they are just becoming fronts or plugging in as the agent for the banks. And the credit card issue a little bit is resolved. And also right now you are looking for stabler companies. In this environment, you're not looking because you are first worried about the market itself. So if the market was to correct, I think it would correct less, and it would go up. I think it would go up sufficiently for it to be part of a portfolio. For us, because of its own poor performance in 1 year, it has slipped from first to third place. Because ICICI Bank, which was slightly lower in our weight, it went up so much more, and even State Bank. But it will always be there. I mean, at least for the near many years future.
Samir, from a sort of larger standpoint, and you've been traveling, what is the perspective right now when it comes to India as part of the emerging market basket? Is the value proposition looking even more attractive than before, given, like you said, that we're starting to come back to, pre-COVID levels across many parameters, and also, of course, in the global backdrop?
So I think there is only one negative, which these investors that I meet once in a while, in the sense that I was half holiday, half meeting. So the thing is, they say that premium of India to emerging markets has gone up to like nearly all-time high.
Wow.
And I say, if you look at India's own valuation relative to its own history, it is sort of in that range of 20 times, 22 times, depending on which year. But it looks high when compared to emerging market index, because China's weightage is very high and its valuations are now very low, maybe I think 10, 12 times.
Right.
So India at 20 suddenly makes the whole thing look very high. So we say, whether you come or not, the Indian guys are buying. And for them, the valuation is not much higher than before.
Right.
Plus, also, actually, if you look at the last 4 years data, or even more maybe, but I have this 4 year in my slide, that the flows into India, and sometimes it's not even flows, it's outflows, but it is disproportionately better than the flows in the region. So even last year, that is 2021, India had inflows of only around $4 billion in FII account, which is very low. But the rest of the region had outflows of $35 billion, excluding China.
Okay.
So even in that 4 billion, actually, India was preferred. The previous year, which was 2020, India got inflows of some $24 billion.
Right.
And the region had outflows, excluding India, of 55 billion, and with India of 30 billion. So India has been preferred nearly every year for the last 4-5 years, very clearly. And I think the reason for that is that people are making a separate bet on India as separate from emerging market. In the sense, it is maybe from their emerging market pool, but instead of giving it to the emerging market manager or allocating it like that, they might be taking a separate China, separate India, and then maybe putting it in the rest of the emerging markets. Plus, you can see it also from the private equity and these VC guys. Ultimately, it's the same investor. It's not the same individual mostly. But it's the same end investor of being a sovereign fund or an endowment or some family office. If they are putting $60 billion in that part of India, then they can't imagine, or they can't plan that this side should be zero, because ultimately the exit for their private equity investment is the public side.
Right.
And ultimately it's the same end investor at a larger level.
We were speaking about HDFC Bank earlier, Samir, but the other financial part which has disappointed a bit, and I'm sure you own some of these names like HDFC Life or ICICI Lombard, is insurance. People were very optimistic, maybe they still are, 4-6 quarters back, but these stocks are struggling. I mean, they're not even keeping pace with the market. What's the problem here, you think?
So one reason could be the COVID-related claims and stuff like that. Also, in the auto sector for ICICI Lombard, there was a big slowdown in auto. And prior to that, the government said, government means who, a regulator, that you have to buy insurance for 3 years at a time. And I think for two-wheelers, 5 years, which suddenly made the cost of insurance relative to the cost of the two-wheeler very high. So all these things are coming up. But in the big picture, they should be there as a small part of the bet, because we have always believed in this competition with state-owned companies. Now, people may say that LIC is a good competitor and does not easily give up market share, but there are many other state-owned companies that can do. Just like State Bank, you may not anymore win share from them, but there are 20 or 5 or 10 other banks, state-owned, that nobody knows or cares about, whether as a consumer or as an investor. So insurance we like as a long-term bet. It might be cumulatively maybe 4.5%, 5% of our portfolio, but we let it be because also one more thing we've realized is we have to look at the portfolio as like a team where every guy does not have to perform every day. Otherwise, all the time we'll be paranoid and what if this stops? Now we always feel okay for 1 year HDFC Bank has not done well. Maybe its time is coming, and that keeps us going. Otherwise, every day you'll be searching for new names because all your 30 names are doing well simultaneously. And I can tell you because I short 20 names and I go long 35 names. So every day, if I look at 55 names and start worrying whether this stock went up correctly or that stock went down, I cannot be as cheerful as I am. We look at the portfolio, and if the portfolio is doing well and the underlying stocks which are not doing well are otherwise justifiable, we actually take it as saving in the bank, which we will use someday.
Okay. One question not related to your portfolio quickly, since we are coming to the end of this interview, is have you had a rethink about crypto? Because most people I speak to are skeptical and cynical about cryptocurrencies, but some people seem to saying that don't write it off yet. Maybe there is a place for it, and maybe some of them will create some wealth even going forward. What are your thoughts?
No, I can trade because I short stocks and all, but I don't think crypto gives me now that even hope that it can be a 100-bagger. So now if you see the best guys say it can be a 2-3 bagger, I mean for now, say they say 40,000 one day will become 100,000, big deal. We have 35 stocks, I can tell you at least 5 of them will go up 2-3 times. There was a time when it went up whatever thousands of %, and that is more that you can regret later. But if a 40,000 thing goes to 100,000 in 2-3 years, it's the same as our equity type return, because there also you're allocating only 2-3%. It's not that you're putting your whole portfolio. So if I'm putting 2-3% in 30 names, some of my stock names will also go up 100-200%, some of them. So now I don't feel that I should join. It might as well just be clear that we don't like it. Unlike Ray Dalio and all, who came on TV and said they don't like it and then said we have 2%, showing the quality of their fund management or their personal belief.
Okay, Samir, we'll leave it there. Out of time today. You have a great time in America and come back home safe, and speak to you after the budget.
Thank you.
Thank you very much. Thank you.
If you like the video, do like, comment, share and subscribe.